Okay. So welcome everyone to our, I don't even know what number session this is now, maybe sixth or seventh session of
Number
our
5.
number 5, our Women and Money Talk series. And today we have Liz Mannette with us, who is a tax attorney and Xoogler. And so before I jump into introducing Liz and kind of getting this talk started, let's just go ahead and, per usual, go and introduce yourselves over chat. We'd love to know who you are, when you were at Google, and what brought you here today, specifically around tax planning. And just a disclaimer, the usual disclaimer, this conversation is not a substitute for actual financial advice. It's experienced folks within our community sharing what has worked for them and how they think about money. And although Elizabeth is an expert and she does have a business here around it, again, this is sort of like an off the record conversation with Elizabeth on these topics, right? So again, please make sure you're consulting the right people before you take action. And the purpose of these talks really is to help our community shift their relationship with money. The goal is for us to achieve more financial independence, confidence, and grow our wealth. And again, we're going to have many conversations and we have more coming up soon as well. So we look forward to seeing you guys there. I'm Stephanie. I am an impact-driven operations and communications leader. I've scaled teams and operations at early Google and the New York Times. I'm also a longtime Xoogler community builder for the New York Network and the Women's Network. So here I am. I co-host these events with Terry O'Connor. Terry, you want to quickly introduce yourself?
Yeah, hi, and thanks, Steph, and thanks, Liz, for coming today. I'm Terry, and I actually have a background in finance and investment, was an investment advisor, and I really have an interest in helping women in their careers and put career transitions and money into the same sort of bucket as far as we need to know both when we're making these career transitions. And I founded a company called The Brass that helps with that and do some salary negotiation classes. But I'll hand it back to Steph. And thanks everyone for coming.
Yes. So introducing Liz, our speaker of the moment now. So she is a Xoogler and also a tax attorney who went to Harvard Law with Barack Obama, which is a really fun factoid. I love that one. And she's been in business for 30 years and loves helping high earners keep more money in their own pockets so they can really invest it in themselves, right? And while at Google, she worked on energy law and for Google Cloud and their data centers. So she's got a ton of experience in these spaces. So that's the quick intro. Liz, why don't I hand it off to you and you can do a more formal intro. And again, the format for people is just asking questions. So as they come up, please do ask. And obviously we have a few prepared questions to ask Liz already. So go ahead and take it away.
Thank you so much. Thank you, Stephanie. Thank you, Terry. It's great to be here with the Xoogler group. And if I have any video issues, I'm going to go off camera because that happened a bit at the beginning. But I think that's just because of the maybe the bandwidth. So I'm glad to be here. As Stephanie mentioned, I was at Google. I was in the cloud group as a data center developer, negotiating energy contracts for Google and helping to set up the data centers in the southeast of the US. But prior to that, and for the bulk of my career, I really was a tax attorney. I started out after Harvard Law School at a big New York City law firm and did that for a couple of years and then started into energy tax and then, kind of focused on energy exclusively. While I was at Google, I kind of decided I wanted to get back into my core specialty. And I really have observed that a lot of the high income earners in Google and elsewhere did not have a good grasp of the tax opportunities or how they can reduce their taxable income. So that really spurred me as I left to think about how I could provide that service and advice again. And my strategy has been to develop a business through acquiring existing tax and accounting firm, some CPAs, and building a brand that will allow me to provide a sort of one-stop shop service to high-income earners, both for their tax return preparation, but also for tax planning and other services. On the call here with me is Michael Miotti, who is a CPA and former PwC partner who works with me in my tax business. So Michael is here, and Michael can say hello. Yes, yes, right. So Michael is here if there are technical tax specific questions that he can answer them. He's a CPA. I'm a tax attorney / business owner, so I don't get into all of the nitty gritty of the tax return anymore, but my firm does provide that service. And my goal is, I mean, the company is called Tax Goals because my objective is to help my clients keep more of their money to further their own life goals. And over the course of your professional career, your tax payments to the government might be your biggest life expense. If you look over 40 years of a career, you may pay millions in taxes if you add it up. And how great would it be if you could take some of that money and invest it in other areas to further whatever you want to accomplish in life? And the tax code provides certain strategies to incentivize certain activities. Basically, the code, although it appears to be complex, it's like a puzzle. Certain activities are incentivized and certain are not. You may be aware of a lot of the conversations going on now in Congress and in Washington with the new administration. What are they going to support? What are they doing? No tax on tips was introduced, no tax on Social Security. Well, the tax code, benefits some people and does not benefit others. And the key is to know what is permitted and then see how you can fit your activities into the most tax favorable positions. And that's what I really want to help, my fellow Xooglers and high income earners understand. How can you fit what you're doing into the most tax favorable positions? I know many of you are W-2 owners, W-2 workers, and so you may only have a W-2 job. Well, you may also want to think about how the tax code is built for someone like you and what you can do to get more benefit out of it. Two of the first things I like to speak to my high income earners about and folks here on this call is you need to know your numbers. You need to know how much you paid in taxes, say in 2024, because that's what you're really trying to reduce. And you need to know that. And I know when I worked at Google, sometimes the pace can be so fanatic or you can be so excited or involved in what you're doing, you don't pay attention to the dollars and cents as much as you should. And at the end of the year or in April when you file a tax return, you might get a shocker that, oh my gosh, I really pay $250,000 in taxes or $1 million in taxes. If you're not shocked by that, kudos to you. But I think it's important. I tell folks, know your numbers, particularly know how much you are paying in tax on a yearly basis, and every paycheck or every pay slip, look at that number. And for those who are in tech, if you have stock tech compensation, either RSUs or stock options, you need to keep track of those of that component, and you should really have some sort of spreadsheet to track every single grant, every single vest, and look at the stock price, look at the vest price, because that is necessary as you think about how to reduce your taxable income and get that big tax number as close to zero as possible. That's my basic intro, but I wanted to share with you 5 main strategies that you can employ that the tax code provides. And I can share this now with the group. 5 main strategies. Are you seeing this screen?
Yes.
Okay. There are a lot of nuances in the tax code, and there are a lot of little issues. But if you think on a big kind of, 30,000 feet view, there are really 5 main strategies you can employ. And of course, you can mix and match and you can decide which fits you, which doesn't fit you. But as you look at your tax, your pay slip, or you look at your tax return or your taxable income, what can you do to reduce the tax you pay? The first strategy here you see is retirement planning. And this, I believe, is something that almost everyone in this call can implement. The first one is to maximize your retirement contributions. And this is something that hopefully everyone on this call can do and employ. But I would be honest with you, in some years, I did not max out my 401k or my retirement contributions. And as I look back over my career, I thought, well, why didn't I do that? That would have reduced my taxable income. And so the first thing is you need to think about that. Are you maxing out your 401k with your employer? Or if you have your own business, do you have a solo 401k, or do you have some sort of IRA that allows you to put aside a certain amount, a maximum amount for everyone that you can then access in your later years, or you can even access if you want to do certain investments before retirement. So that's the first strategy. Maximize retirement contributions. The second strategy is business ownership. You see, the tax code basically provides incentives for economic activity through business ownership. It allows you to get a lot of deductions for expenses that are necessary for your business. And those expenses, depending on how you are involved in the business, can actually reduce your W-2 income if you still have that high W-2 income. And so the key is, what can I do, or how can I structure what I'm already doing to reduce my W-2 income? If you have a side business or some freelance work, or you're investing with some others, how can you be active in that business so you can reduce some of your taxation on your W-2 income as an employee? So that was the second one, business ownership. The third pillar, the third strategy is real estate investing. The fourth one is charitable gifting. And then the fifth I put as energy incentives. So those are the five: retirement planning, business ownership, real estate investing, charitable gifting, and energy incentives. So we spoke about maximizing retirement contributions, then possibly getting involved in business ownership. The third big area is real estate investing. Basically, Congress and this government wants to encourage real estate investment activities. And so there are a lot of incentives if you invest in real estate. And some of those investments can actually produce losses that to some extent can offset some of your W-2 income. So you don't have to be a full-time real estate investor or realtor, but it can be one component of your your growth of your overall net worth and what you're doing with your time and your money. But it's a tax favorable strategy. And the key thing about real estate investing is you have to look at what type of real estate you're doing, how involved you want to be, is it short-term, long-term rental, etc. There are a lot of little nuances, but that's the big strategy to reduce your taxable income.
And so, Liz, if I could ask a quick question about that one.
Mm-hmm.
Real estate investing is different than real estate just ownership of your own house, but both actually do give some tax breaks,
Yes.
right?
Yes.
Why is real estate investing more
beneficial?
Beneficial, yeah.
Yeah. Well, if you own your own home and you itemize your deductions, the tax code allows you to deduct, say, if you have a mortgage, you can deduct the interest you pay on that mortgage, or if you have property tax, you can deduct that. And that reduces your taxable income. So
Sure.
owning real estate gets a tax benefit. Now that's just a choice. There's no kind of philosophical basis for that. It's a choice the government has made. We want to reward people for owning their own homes and incentivize home ownership. So you can reduce your taxable income to the extent you have a mortgage and you're paying interest, property tax, etc. And then when you sell your home, eventually you possibly could have some savings by not paying tax on the full gain up to a certain amount. So that's the individual home ownership. the real estate investing is different in that it really is not just the benefit for owning a home, it's a benefit for having real estate property and being able to deduct certain expenses against that property so that you're not paying a tax. Say if you have if you have earnings from a rental, and at the end of the day you may have a profit. Well, the way the tax code is structured, you can deduct certain expenses from that real estate activity that may even result in you not paying any tax on what was otherwise a profit. And the big
Wow.
area is really depreciation. Let's say, for example, you have a piece of real estate, a property, and at the end of the day, you do make a profit because you're renting it and you have some expenses. But because you can depreciate and write off that real estate investment over time, you can end up with a tax loss, but you have a profit, cash profit.
Hmm.
That's the real benefit for real estate investing, that you can actually have depreciation that gives you actually some a tax loss. You're not paying tax on the profit you otherwise would have. And then
Got it.
depending on your income, if you have a loss, you may be able to deduct it against your W-2 income, depending on your total income and your level of participation in this real estate investment activity.
Yeah,
Got it.
this is great. Stef, I had a follow-up question, Liz, about real estate investing. Does it matter? I mean, there's probably very detailed, tax laws does it matter what state you own property in or what country? I know we don't need to get into details here, but just curious about, is owning real estate in your state, is that where you want to really kind of focus, or is it okay to own real estate in other places and you still get the tax benefits?
You can own real estate anywhere in the US. I mean, the nuances come into play where if you're trying to say you're actively involved in this real estate investment. Well, if you're living in New York and the real estate is in California, how do you show you're actively involved in it, participating?
Yeah.
But if I mean, if you have a two-family home or something and you're renting out one part of it, or if you have something in the neighborhood and you're kind of managing it as an Airbnb, you can show you are actively participating in that. And because of the proximity, there'll be less critique of that. But generally, you can invest in real estate across the US. You get the same type of benefits, just there may be some nuances.
Oh, thank you.
Michael, do you want to add anything?
Yes, no, that's spot on. I would also mention, there are specific additional incentives to invest in other areas of real estate. So, for instance, opportunity zones present their own unique opportunities from a tax savings perspective, versus owning a piece of real estate where you get those incentives. Opportunity zones, it's a separate section of the code which the government has incentivized folks to invest in certain areas, developing areas, and there are a lot of extra incentives from a tax perspective to investing in that area of real estate in particular.
Yeah.
Thank
And I
you.
think what ladies people on this call can be thinking about is, I don't have to do this on my own. I can partner with someone, or there are folks who have syndicates. I mean, you can find someone to do that activity for you or to partner with you, and you get benefits. You can leverage whatever capital you have and you get certain benefits. I mean, your participation level is important, because if you're just a passive investor and you're just getting, you're passively just kind of receiving some, income at the end of the year or periodically, you don't have as many of the tax benefits as opposed to being an active investor. But at the end of the day, it depends on what appeals to you as an individual. Are you more inclined to business ownership, or are you more inclined to investing in real estate? Or the fourth category is charitable gifting. And are you someone who wants to support certain charitable or non-profit causes? Then the tax code incentivizes that in a different way. If you have a lot of, disposable income, and you think, how can I support a particular cause, a particular project? Well, the tax code can provide certain deductions for you supporting those projects or those tax exempt activities, and it benefits you by reducing your taxable income. How can I reduce my income tax on my, say, my W-2 income by doing things in a different way? So the charitable gifting is a very, very, very significant strategy that particularly tech workers, if you have appreciated staff, you can think about doing.
Yeah, we have some questions in the chat. So the first one is from Cindy, and she just wants to clarify, is real estate investment depreciation, what you were talking about earlier, the same as cost segregation analysis, or are there other types of depreciation that we can explore?
Well, the real cost segregation is a strategy to allow you to depreciate different aspects of your real estate property differently. So there's depreciation, which is write off a useful asset over time. Now you can depreciate a vehicle, you can depreciate equipment, you can depreciate software, anything that has a useful life of over 1 year, you can depreciate over time. Basically, the concept is this, let's think of a car. This car is losing value over time. Well, the tax code allows you to take that value as an expense each year, once it's being used in business or, say, in real estate. So you're depreciating, you're taking the wear and tear as a business expense over time, right? Now, the cost segregation is the strategy where instead of lumping your entire, say, your apartment building as one piece of real estate that can depreciate over, 20 plus years, cost segregation is a technique where you can segregate each component of that property into categories. So, for example, your HVAC system is one category. Your kitchen cupboards might be another category. Flooring. So you're basically segregating the cost of each item in this big real estate property. And that's allows you to depreciate it over a shorter period of time, because the overall depreciation schedule may be 27 years. But if you subdivide each aspect of this real estate into different categories, you can depreciate different parts over a shorter period of time. For example, appliances won't last for 27.5 years. So if you segregate all your appliances in your real estate investment property, you can depreciate those, say, over 5 years, 7 years. So you get the expense deduction over a shorter period of time. So it's an increased deduction, as opposed to depreciating over, let's say you have $100,000 of equipment, depreciate over 27 years, that's one cost. But if we depreciate over 5 years, that's a much higher cost, higher expense deduction in 5 years. So that reduces your taxable income much more.
My brain is exploding right now. This is amazing. No, in a good way. In a great way, Liz.
Michael wants to add something. Michael is a CPA. He's been doing this for, I don't know how many years, more than me. So he knows the nitty-gritty. I'm very big picture. Okay.
Liz, we love this. Yeah.
You say something about the cost segregation?
Liz, you're spot on in terms of the benefits of that. It accelerates your expenses. So that's very beneficial, but it's a complicated area. It's where we help, a lot of our clients, but it's an area that's very technical and, requires you to follow, the code meticulously. Otherwise you get tripped up and, you end up in a spot you don't want to be in. But it's a great strategy that a lot of folks do. And, we highly encourage that, and a lot of opportunity there.
If you think about, real estate investors who you hear, no, don't pay any tax. Why don't they pay any tax? Because they have all this property and they depreciate, they do cost segregation studies, they depreciate everything down, and at the end of the day, they have a zero taxable income. but they have property, they have assets, they have income, but the appreciation brings the taxable income down to zero. So
Now we
that's
understand
why
why.
you hear certain people, oh, we have a real estate investor, I have 500 million in assets, I didn't pay any tax last year. I mean,
And I would add too that, there are strategies where, you could have a large capital gain, let's say from, the exercise of options and stock and, investing in a certain type of real estate. Again, I'll mention opportunity zones, provides extra incentive where you can defer the payment of those taxes to the future. It also affords the opportunity to for that investment to grow on a tax-free basis as it relates to capital gains. So there's a lot of opportunities as it relates to the real estate space. And in particular, we see a lot of clients that take advantage of when they have a large capital gain. It's an opportunity both to defer and then for any appreciation on that to have a tax incentive that really is is very, very unique and grows on a tax-free basis for years. So a lot of opportunities in that space where we work with a lot of our clients on.
Yeah, and just to interrupt quickly, I recognize that not everyone may be in the position to purchase a investment property, and so how much more time do people want to spend on this topic? Because I think we could keep going, honestly. This is it's interesting for sure. And now it makes a lot more sense to me as to why some people, some very famous people as well, do not pay crap in taxes and have gotten away with that for so long. Actually, okay, let me ask this question from Shirley just to wrap it up, and then hopefully we can move on to some of the other topics too. So the question from Shirley is just, for real estate investing, do you recommend setting up an LLC and investing, or can you still get the benefits of property set up under a trust for a long-term rental specifically, I guess?
Michael, you want to answer that about a trust? The key thing with real estate is you want to have each entity separate. I mean, the LLC is primarily to protect you from liability, to be honest. That's the primary thing of putting your real estate in an LLC. But if you are the only owner, you still get the benefits of the deductions flowing through to you.
Yes, and I would add, in terms of the trust versus an LLC, the trust that's a whole, an area that we could spend, hours talking about. And it really depends on the type of trust. It depends on your overall situation. And but depending on the type of trust, you could receive the benefits, but there are others where you don't want to receive those benefits. Folks may not want to. So it really requires an overall look at your situation and coming up with the right trust or the right LLC. Both of which are options.
Yeah, and the trust structure is generally for kind of like estate planning and protecting your assets and again and preserving it for heirs, etc. But what we're talking about tax planning, you will still get you could still possibly get all the benefits you otherwise would get in a trust, but it depends on how the trust is structured.
Right, and oftentimes with a trust, to get those benefits, it's really, if you want to keep those benefits, it would typically, it would really be a strategy for protecting from a liability perspective. So that's that's one key area with the trust as well.
Okay, let's go ahead and move on. Let you finish with the other two: the gift, the charitable giving, and the energy incentives.
So the other two strategies I mentioned were charitable giving, and that's not just making a donation to, say, a charitable, a tax-exempt entity, whether it be, social, not social, but a club or a church or a synagogue, etc. But also setting up to fund this entity or this charitable group over time by making a deduction in 1 year. Let's say, for example, we had a client who had the invitation to exercise some options and would have had a huge gain. Well, if he had made some contributions of that particular stock to, say, a donor advised fund or some other charitable nonprofit entity, he would have gotten a tax deduction in this year, and he wouldn't even have to pay it out to the charity immediately. You could have done it over some time. So there are strategies to use charitable structures if that's something that is really important to you and you want to include. If you don't, if you don't need the money immediately, but you think you want to give it or gift it and get the benefits of that, you can go away, not just putting a solar panel on your roof, etc., but getting investment tax credits in the type of activities that the government is seeking to reward. Right now, there's a lot of talk about stimulating oil and gas investment again, and so those credits may or may not be strengthened. You get credits that can offset your taxes again, or investing in like a solar tax project, you get credits, investment credits that offset your taxable income. So you're looking at how can we reduce our taxable income? How can I invest or take certain actions that, hey, these things, they generate returns, one, and they increase your net worth too, which are the, at the end of the day, that's, I think, the main goal. How do I increase my net worth, increase my cash flow, but do it in a way that's tax advantaged? I get a tax deduction for what I'm doing. Because it's not just about saving taxes, it's about kind of growing your net worth, becoming more financially independent, maybe even financially free, where you don't have to work anymore and you have a cash flow coming in over time. So these are the 5 strategies: retirement contributions, business ownership, real estate investing, charitable gifting, and energy incentives. So using these can significantly reduce your taxable income. And it varies with each year. It's not going to be the same each year, but it is possible to get your taxable income down to 0 in 1 year, but depending on how you're doing that, it may not always be the same.
And Sheila has a quick question of clarification in the chat, which is just for charity giving, does it have to be a 501c3 or can it be a 501c6?
501c6. It has to be a 501c3 generally. I'm not familiar with a 501c6.
Sheila, do you have an example of a 501c6? What's that?
I do. So it's a league or municipality type of tax exempt status. So like, for example, I think like the Democratic Association would be that, or something, a local group. Here in my town, it's an Irish organization that's not a 501c3. It's a 6.
No.
And I'm always confused about it. That's why I asked Elizabeth, because I prefer to make donations, but if it doesn't help me, yeah, that's all.
Yeah. Well, the tax deduction for the contributions to a charitable organization has to be a 501c3. There may be deductions for contributions to other 501c organizations, but not under the charitable gifting strategy and the charitable donation. Because you may, I'm seeing you may actually be able, depending on what, if this is a local business chamber of commerce or something like that, is that what it is?
Yes.
Well, then if you have a business and you are part of this chamber of commerce and you make a contribution, that could be a business expense. So you see, that's another benefit of having a business. You can deduct costs that an individual who is not a business cannot otherwise deduct.
I got it. Okay. Thanks so much.
Yeah, that's what I'm seeing is the IRS page summary. Yeah, so
okay.
Spot on, Elizabeth. Yeah.
Thank you. Okay, so Google agrees with me. That's a good thing.
Google agrees. Yes, yes, yes.
Google and if it's AI, Gemini, whoever.
I would love to ask a question about RSUs and capital gains taxes. And I think I'm assuming everyone on this call kind of understands the basics about long-term and short-term capital gains. But many of us have RSUs. Some of us are in the position where we may be selling them. And what are some of the things that we need to understand about this in terms of like the basics for how we can avoid tax pitfalls? Yeah.
Well, the first thing I know, when I was at Google and I was thinking of selling some of my Google shares, you have to track I mean, in your brokerage account, you should see each vest and the cost. Well, when you got it, I can't remember the terms, but the cost of the shares on the day that you were granted the comp, and then when it vests, and then when you're looking to sell it, you've got to look at the cost at the price at each period of time, because that's how you compute what is the gain or loss. And if I sell on X day, how much gain will I have or loss? And then you have to know your tax situation to know how the specific impact on you. So for example, if you're selling and let's say you have a tranche that has a loss over time, you want to sell that particular set of shares, you'll have a loss, a capital loss. You can use up to 3,000 of a capital loss to offset your W-2 income. But let's say you have some other stock that, or some other tranche of shares that have a gain. Well, if you sell that one that has a gain, it might be offset by the shares that have a loss. So you can kind of have a net zero tax impact, but you still get the cash you want to get from selling shares. So the key is you have to know, and I had to create my own spreadsheet, and I kept saying, somebody must have a spreadsheet somewhere. Why do I have to do this myself? But I had to create my own spreadsheet to track my particular cost basis, not just what's in the brokerage account, because you have to look at the day, the value of the shares, the market price, and figure out, okay, if I sell on X date, what would be the impact? So you really have to track it. You have to really take this as understanding your own comp and understanding your financial situation. I know there is someone who I think has developed a product for FANG workers who have these RSUs and who have this particular issue. And I think this product helps you to track it a little more carefully. Was that an answer to your question, Stephanie?
Yeah. And I'm also seeing interesting things, and something that's come to mind for me recently because I was looking at selling shares, right, is that when you have a long-term capital gains holding that you want to sell, there's some number of that is actually taxed at zero before the 15% kind of, everybody knows, oh, long-term capital gains is a 15% tax, right? But prior to you hitting that 15% mark, the first however much, I don't know exactly how much,
Depends on your income, Michael. It depends on
oh, is that how that works?
Yes, exactly. It depends on your income.
I see. So if you make more than X amount of dollars, it just hits you at 15. But if you say, for example, for me, I'm in between jobs right now, right? And if I stay this way all year, I may have quote unquote zero income, let's say, right? Which, oh God, please don't let me have zero income. But anyway, I could have zero income. And if I sell shares up to a certain amount, then I'll be taxed at zero. Okay, so for people who are in my similar situation, who may be in transition or in between things, that's something that's good to know too, that if you need to cash out some shares, you can cash out up into a certain amount and you wouldn't get taxed on them. And then after that, it'd be taxed at 15%, assuming again that these are long-term holdings.
That's right. I mean, it depends on your filing status, but generally, if you're under 47,000 of income, you don't have to worry about capital gains, but it all depends on your filing status and income and
Got it.
yes, but those that is available.
So you could conceivably sell some of your stock if let's say your income, let's say December, and well, okay, for this year I've only made X amount. You sell some of your stock, you get the benefit, you sell it, you get the cash that you need in hand, but you still, and so you don't pay any tax on that gain. And you take that gain out. If you want to again say, oh, I really want to stay in Google, I mean, you can purchase a stock more than 30 days later or something, and you get back into the stock position, but you have the capital gain pulled out without tax.
That too. I learned that as well, that a lot of people do that. So like you sell the stock that you got at a low price, into
Yeah.
whatever the maximum is for the year that you can afford, you get that completely tax-free, and then you buy back at the higher price.
Yeah.
And you can just keep earning.
That's
I
how you
mean,
take some of your, like the gain on the stock. The stock is appreciated considerably, thankfully.
yeah.
Back, I would add, if the rules there are particularly complex, and
Michael was cautioning us. He was like, it's incredibly complicated though.
Yeah,
yeah,
you
I
have
was
to
no,
keep track of every share and the value of the share. That's why I told you I had to do my own spreadsheet.
yeah, and you can easily get tripped up like with that strategy of recognizing a loss, taking that tax benefit, and then getting back into the position. You can easily get tripped up because there's a 60-day window. So you have to be careful to make sure you don't get tripped up by the tax rules, because even missing it by a day, would disallow that. And it's an area the service pays particular attention to because of that strategy is very beneficial. And I would just say in general with ISOs, you have to make sure you meet the holding requirements, right? So, you want to pay particular attention to that. And, so that's a key area as well.
Okay. Can I say back, because I feel like everyone is like, what do I need? So for those of us who maybe are earlier Google, right? We have early shares. They have appreciated a lot, right? And one of the tax advantaged ways of getting that money basically is looking at our income first, right, Michael? That's like and Liz, that's the most important, that we got to look at what we're making now first. Actually,
right.
Okay. Actually, maybe you guys can summarize quickly, kind of like the strategy, and maybe it's better if someone else does it. Summarize the strategy quickly, and then, but obviously let's big caution, because it varies per person, right? So.
Okay, yeah. Well, a lot of people do this at the end of the year. You look
Okay.
at where you are from an income point of view. You also know your filing status and some other things about yourself. And then you determine, okay, again, you have to track each tranche of shares. You've got to track your cost and you've got to look at the market value. So if I sell, you determine what you can sell, what the market price would be, what your gain would be over the long term, and based on your income, you can identify whether you pay tax on that gain or not. Or if it's a loss, you pay tax. If it's a loss, you have that loss that you can use to offset other capital gain or up to $3,000 of ordinary income from your W-2 job. So if you have Google stock that you held for 10 plus years, significant gain. If you expect that you will not make more than 45K this year, you sell some of that stock, you get that gain, but it is taxed at zero. But when you have to be very careful. You got to look at the numbers, and you've got to have a CPA really advising you, because you don't want to make an error.
Yeah, that makes a lot of sense.
Yeah.
Okay, what other questions do people have?
One of the things I want to stress overall is that you can't leave tax planning for the end of the year or for April 15th when you're doing a tax return. That is not, April 15th is really too late for any planning for 2024, more or less, with very, very, very few and limited exceptions, like, making some kind of retirement contribution if you have your own 401k. But you've got to really think of tax planning as something you do kind of, I would say, as soon as you do your tax return for last year, and we can help you with that. You do your tax return, you look at your tax situation, then you know what you're doing this year. You're still in with Google. Are you looking at diversifying? Are you in between jobs? Do your tax planning in, say, May. Start to look at it in May and determine, okay, what can I do this year? And then again, check, look at in October, I would say September, October. And then in December, before the end of the year, what can you do or what you need to do before the end of the year? Because most of the tax planning is done on a calendar year basis. So you've got to complete certain things by the end of the year. There are several that can be pushed into up to April of the following year. But you've got to look at your tax situation during the year and find someone who actually likes to do that. So that's what I like to do. I actually enjoy helping people plan to pay the least amount of tax possible. Again, I say, so you can use that tax payment to fund your other goals in life. Not
Right.
necessarily that you're trying to just, not pay any money to the government, but you've got other things you want to accomplish. And I suspect the people on this call are going to be doing good things and great things and investing in, new companies or real estate or supporting charitable causes. You're not just going to you may take the money and buy a yacht or something, but more likely you are investing in the country, you're investing in your community, you're investing in yourselves, you're growing your net worth, you are contributing. So taking some of the tax money that would go to the government and investing in something else is a continuous contribution. So you shouldn't feel like you're doing something that's not right.
Right. We have two questions, one from Shani and then maybe also Terry. So go ahead, Shani.
Thanks so much. This is really helpful. Particularly that last thing you said, because I always feel like, are we cheating the system when you try to like figure out these tax loopholes? But I'm starting to get it. So my question, so I'm in a similar situation to Stephanie and probably a lot of people, tech layoffs, yada, yada, look in between jobs. I'm thinking about taking some freelance contract work, but that's not going to be necessarily long-term where I would set up my own LLC, et cetera, et cetera. Is there anything I should keep in mind from a tax planning perspective when generating income as a freelancer? Like if it's not on a W-2, I don't know if it's a 1099. Obviously I can't contribute to a 401k, but I have an IRA.
Okay. Well, if you're doing some freelance work or even temporary work, you are in fact running a business, right? It's a business. And as I said earlier, as a business, you have certain deductions that you can take. There's certain things you can do, including setting up your own solo 401k. You can do that. And in fact, you have a lot, you can contribute up to almost like 70,000 to your own 401k if you have your own business. So think about that. I mean, there are limitations, but you have a business, even though it's not registered, you don't have an LLC, you are in fact doing something for profit and you're not employed as an employee. So that is a business. So start to think about that as a business. Secondly, as a business, you've got to keep track of all your expenses because at the end of the day, the tax code allows you to deduct those necessary expenses that you incurred to actually provide that business service. So if you're working with another company and you have to pay for your own, let's say you have to pay for your own cell phone or your own internet, or if you're working for several clients and you're traveling to the offices, you have all those costs that you can write off. And again, I mentioned depreciation depending on what type of business it is. If you have to buy certain equipment, you can depreciate the equipment over time, or you can even take the full deduction in 1 year. So keep track of all your expenses. Consider that you're running a business now. I mean, you have to be working at it for a profit, but you could have a tax loss in your first few years. That's allowed. And just maintain your expenses. I always say, use one business card or one business account to track everything. So everything goes into one account so you can see that easily at the end of the year. That's the main thing I would say. And also look at if you have the opportunity to set up your own 401k, that's one way you could reduce your taxable income. But of course, the money goes into a 401k. You are limited to what you can do with that. So you have to be cognizant of it.
That makes sense. So, and just to wrap that up, so even if it's for a portion of the year, not like say I do freelance work for just 3 to 6 months, and then I get something full time, I can still deduct those expenses for that short period of time.
Yeah, because you had a business. Okay. Once you have a business for 1 day, you have a business. I mean, expenses have to be reasonable. I mean, you can't say I work for 1 day, so I bought a car for 50K and I'm going to write off my car.
Darn it. Squashing my dreams, Elizabeth. Kidding. Terry,
do some business work on the weekend. You can still work on the weekend, but if you have if you have a vehicle and you're using the vehicle in business, you can write off a portion of the vehicle that's used for business. So if you have a rental and you're driving around to your rental, or a rental, you're driving around, or you're looking at property, that's all business. That's all a business expense.
We have an interesting one from Melissa. And Terry, do you have a question as well, though?
Yeah, I just wanted to say thank you, but also Liz and Michael. And I think there's a lot of people on the call from both the East Coast and the West Coast and in between, and wanted to know, like, where does your business, what's your business reach? Do you do every state? I'm speaking from my own point of view of being in California. I need help. And was just wondering, what's the scope of your business and your market?
Well, we have a firm that is remote. It's a virtual firm, and we do tax return preparation and tax planning for clients around the U.S. in every single state, and those who may be U.S. taxpayers resident overseas as well. So we're not limited to any
Nice.
state. We have a good team. Michael is a very experienced CPA, former PwC partner. We can help you, and I want to help you. That's why that's why I started this particular company, and I'm reaching out to ex-Googlers. We can help you in the tax preparation, but also in tax planning going forward. If you want to talk through any of the real estate issues, certainly we are open to do that.
Fantastic. I'll put it on my calendar for May. Like you said, get your taxes done, do May, and do some planning. I just really appreciate that. You're international, and I think that's real helpful.
Yes, I'm going to put now the firm I bought is David Beck CPA, so I still use that firm's email. So David Beck, but of course I'm in the Xoogler chat, Slack channel. You can reach me, Liz, at davidbeckcpa.com, or my full name, Elizabeth Mannette, in the Google chat.
We have one quick parting question from the chat just to wrap it up for people. And then I want to just close out the call. So tax advantages for hiring your children for your business.
Yeah. Well, if you have, you can hire your children in your business, and if they make, say, less than whatever the standard deduction is, maybe 13,000, 14,000, they don't have to pay tax on that. So let's say you hire your child as to work in your business, and they do some child appropriate work. Could be your child could be a model or the face of your business, or help you with social media if they're a young teen, etc. You can pay them up to whatever, no child labor. But if you have, let's say you have a dental practice for children, and you have your children in the ads for your dental practice, you can attribute or pay them a certain amount, and you get that payment as a tax deduction because they're a worker. So you can take that off your taxable income. They don't have to pay tax on that amount because it's under the standard deduction. So as I told one client, and he had a 16-year-old, and he was thinking about going to college. They're going to college. I said, well, you can pay this 16-year-old in your business. Let's say you give them, $10,000. Well, they're not really using that $10,000. You put it in the bank account for their education. But that's how you can deduct the $10,000, because it's a business expense, because you're paying this child as a worker, and they are not paying tax on it. So it's really $10,000 that you have been able to take out from a taxable point of view. Is that clear?
Got it.
Right.
Yeah. Melissa, you feel good about that? You have any more? Okay.
Yeah.
All right. Guys, thank you so much for this. Liz, Michael, we appreciate you both so much. Again, this is the first of many conversations, so definitely send Terry and I your feedback and thoughts if you want to hear more sessions. Elizabeth, wow, just your knowledge is just blowing my mind right now. So this is incredible. We'll be back in touch next month with more of these conversations. Thanks everyone for your attention and participation.
All right, thank you all.
Thank you. Bye-bye.
Bye-bye,
Bye.
everyone.